Tonight we're speaking to Rashaad Tayob from AEON Investment Management. Kevin Lings is still with me. Thank you so much, Rashaad, for joining us today. Much appreciated for your time. We're looking at the Absolute Return Fund. I know the aim of the fund essentially is to protect against capital deterioration. Just taking a look at how your fund has performed in the months of September, down only 0.3%, where we saw the overall market down 4%. What is your strategy to protect to the downside? Are you embarking on hedging at this point? And if so, what exactly are you doing right now when you look at the negative scenario that could be playing out? What are you shorting? What are you going long in?
Well, at the moment, we always run a hedged portfolio on the equity side. So the primary aim of the fund is to protect capital, and in order to do that, we use derivatives. But it's not derivatives in any scary sense of the word, but rather in an insurance sense. So we pay a premium, and if the market falls, we get compensated for our losses. If the market rises, we get the benefit of the up market, but we lose that premium. So at the moment, we've been well positioned, we've protected against any drawdowns, and we focused on delivering returns in the bond space and in the inflation-linked bond space.
Rashaad, if I look at the breakdown of your fund now at the moment, would you agree that it's fairly conservatively positioned? Would you describe yourself right now as being conservative in the current environment? Or do you think that you've got still quite a lot of risk in the market?
I mean, this fund by its nature is a conservative fund. We're trying to protect against drawdowns. We're appealing to the conservative investor who wants to sleep soundly at night. At the moment, we have about 45% equity exposure, but it's fully protected using derivatives. We can vary that over time up to around 70%. So at the moment, I would say we're in the middle of the range. We're not conservative. We're not aggressive. Yeah. So at the moment, I think we're pretty much in the middle of the range.
Well, looking at the breakdown as well, you've got, as you mentioned, 45% in protected equity, and the next biggest chunk, you're looking at 32% into 0 to 1 year fixed income. So give us a little bit more detail on that and why you've chosen to be in that longer end of the curve, or the shorter end of the curve, pardon me.
Well, we've had a much larger position in bonds and inflation-linked bonds, up to around 30%, up till early last month. But because you had that big run in both nominal and real yields, we decided that it was better to shift that into the money market space, maintain a conservative fixed income exposure, and now, given at these higher levels of yields, we're looking at re-entering the bond and inflation-linked bond space, because we think that the potential at these levels for real returns is much better. So we took advantage of the bond run. We sold out, and now that yields are at high levels, we do want to get back in it again. But at the moment, we're sticking with the money market space. We think that offers good value.
Rashaad, you've got quite a lot in inflation-linked bonds, and you mentioned that you may want to continue to up that weight. I think you're sitting at about 16% or thereabouts in inflation-linked bonds. Yeah. At what point would you consider that that level is now quite substantial given the nature of your fund? In other words, what is the type of level that you would take inflation-linked bonds up to? Would it be 20%? I mean, obviously, overall, you're still very underweight general or nominal bonds, fixed interest instruments. Yeah. But what sort of investment could the investor look for in inflation-linked bonds in your fund?
We've actually reduced from 16% to around 8%. So our aim, I think at these levels, we'd look to take it to around 20%. There is quite a bit of duration risk in bonds. At around 2.5% real yield, we do feel that it's reasonably attractive. But if those real yields kick up, maybe driven by international real yields, then you can have some drawdown. So I think our maximum level will be anywhere around up to around 20%.
And just following on from that, if you look at your equity exposure, you're saying that equity exposure is more or less in the sort of mid-range.
It's in the middle of the range. Yes. Over time, our primary aim is to protect capital. And if we can protect capital and help the investor sleep soundly at night, and at the same time capture around 50% of the market upside over time, we think we're going to give the client a very attractive return profile and give them that certainty certainty against protecting against drawdowns.
Of course, now we're into the fourth quarter. You mentioned that you've taken inflation-linked bonds in your portfolio from 16% to around 8%, if I'm not mistaken.
Yes.
Does that mean that you've reweighted the portfolio? We're looking at different asset class allocation at this point, given the fact that things are changing quite rapidly on a macro level.
Yeah, I think things are moving a lot rapidly than they used to. So you had a huge rundown in bond yields and inflation-linked bond yields, which is the reason we took it down in quite a short space of time. And given how far they've kicked up last month, I mean, you're seeing in 1 month inflation bonds delivering 3% return, last month delivering -2%. Because of that -2% return, a lot of the value has come back, and because of that, we'll shift back into it. So because of the market movements, we're moving a bit more rapidly than we used to. We would generally take a 6 to 12 month horizon, but if things move, then within a month we can change the asset allocation of the fund.
Rashaad, can I just ask you, in terms of the current global environment, which obviously has an impact on the domestic economy, what type of circumstance would you be looking for in order to take your fund a little bit more aggressive? In other words, what are the typical sort of trigger points where you say, okay, I'm kind of mid-range in terms of my equity exposure, but I think I need to up that exposure because, let's say, you think valuations are more compelling. What are the typical trigger points you look at?
I mean, the key for us is two things. Firstly, it's our asset allocation strategy. And that's driven by a combination of valuation and momentum. So at the moment, our models are telling us that equities are in the middle of the range. If they fall, if we find a drawdown of, say, 15 to 20% in the equity markets, it'll cause us to believe that there's more value there. And once the momentum turns, we would then shift to a more aggressive position. The second factor is also the pricing of the derivative protection. So at the moment, derivatives volatilities are higher both locally and globally, which means that the insurance that the derivatives are more expensive. It's costing us more to insure the portfolio, so it constrains us in how much upside we can deliver. If things calm down, the volatilities will fall, the cost of protection will decrease, and we can afford to be more aggressive. So the combination of our asset allocation strategy and also the price of derivatives, the price of protection, is what guides us in setting our level of between conservative, medium, and aggressive.